Good morning, students. Welcome to this session once again. So today we are going to continue with our discussion on tax audit. In the last sessions, we have discussed about certain clauses of Form 3CD, and we are going to continue with the remaining forms of Form 3CD, and we also plan to start with another type of audit today, that is GST audit. So moving on to next clause, that is about clause number 32, which talks about details regarding brought forward loss or depreciation allowance in the following manner and to the extent which is available. So let's understand what is the information which has been asked over here. Whether a change in shareholding of the company has taken place in the previous year, due to which losses incurred prior to the previous year cannot be allowed to be carried forward. Whether the assessee has incurred any speculation loss as referred to in section 73 and details of that loss. Whether the assessee has incurred any loss as per section 73A in respect of any specified business. In case of a company, please state whether the company is deemed to be carrying on speculation business as per section 73. If yes, please furnish the details of speculation loss, if any, incurred during the previous year. Now, in this respect, primarily it starts with the brought forward losses or depreciation. This is because of the fact that when ITR will be finalized, then any losses which belong to the previous years may also be getting adjusted. And during the year, if there are any changes in terms of the shareholding pattern, or if there are any specified businesses as per various requirements of the Income Tax Act, due to which any of those losses require specific treatment, or any of the losses may not be allowed in respect of adjustment with the total taxable income, then such information would be relevant for the income tax department, and that seems to be the logic behind putting up this clause. Now, for this clause, the first step for the auditor, now we'll get on to the audit procedures. First step for the auditor will be to verify as to what was the number which was reported under this clause in the previous year. Because in the previous year, some amount of depreciation which has been carried forward, or unabsorbed depreciation, or this brought forward loss would have been reported. In the ITR, that means in the income tax return of the previous year, some amount must have been reported. So now that will become the basis for the auditor to verify as to what's the amount that he needs to start. Okay. After checking this, so this is about tracing the balances of the last year with the current year's Form 3CD. Then the adjustments which might have taken place during the previous year, or which might have taken place during the adjustments in relation to previous year's income tax return. When I say previous year, I'm talking about the current year, means this year for which the ITR will be submitted or the tax competition is going on. Now, in this respect, auditor is required to provide auditor is required to obtain all of these details from the assessee and verify them. Now, this part will also require the auditor to get into the income tax computations or the adjustments related to all of these sections, whether those have been adjusted appropriately or not, while computing any of the unabsorbed depreciation or the losses. This will also require the auditor to have understanding about the businesses of the company, and all of these points can be best understood by, of course, getting into the transactions of the company, which the auditor would do. He would review, he would verify the transactions by going through the books of accounts of the company. But at the same time, he also needs to have discussions, inquiries with the management to understand if there have been any such businesses which have been referred under any of these clauses. Because if there are any such businesses which may have taken place during the year and which may not have been there in the preceding previous year, then such information would also become relevant for the auditor and of course for the purposes of management to report such information under this clause. Okay. Moving on to next clause, number 33. Section-wise details of deductions. Section-wise details of deductions, if any, admissible under Chapter 6A or Chapter 3, that means Section 10A, 10AA, etc. Now, under income tax, you must be knowing that various deductions are available under Section 80. Now, all of those deductions which are available under Section 80, those are the ones which are referred to under Chapter 6A. Similarly, there are various deductions which are available under Section 10, 10A, 10AA. Now, all of those deductions are required to be covered over here. Now, for this, once again, what will the auditor do? Auditor would need to verify the supporting documents on the basis of which such deductions would have been claimed by the company. In case any of those deductions are not the one which the company can claim, that means those deductions do not fulfill the criteria or the requirement of the company, then such deductions should not really be reported over here. And for this, once again, the basis of testing of the auditor will be to look at the last year's Form 3CD, because on the basis of last year's Form 3CD, auditor would be able to comment whether he has been able to obtain all the required information or not, because something which would have been reported under last year's Form 3CD, that will give him the, or you can say that will become a guiding factor for the auditor to proceed on this. So if there have been any new type of additions in respect of all of these deductions which are required to be reported, then that part can also be looked at by the auditor. Now, all of these things would become important for the auditor in respect of looking at any of these deductions. Plus, all of these deductions which would be reported over here, auditor would also need to verify the supporting documents. Let's suppose if there is any deduction which an assessee has claimed, let's say in respect of certain investments. Now, what will the auditor verify? Auditor will verify those investment documents to check whether they will fall under this particular section or not. Because some of the deductions assessee might have been claiming or maybe planning to claim, but that may not be really eligible to be covered over here. So this therefore requires an understanding of Income Tax Act, not only on the part of the assessee, but also on the part of the auditor, as we have been discussing throughout the course of tax audit. But particularly in this case, if one has to get into the deductions, etc., which are very important for the purposes of computation of tax or the taxable income. The other aspect around all of these deductions will be to check the limits. Okay. Now, some of these deductions which can be claimed by the assessee are again cut down to a particular threshold. So that is again one area which the tax auditor should remember, that all of these deductions for which some of the documents may be made available by the assessee could be there, he might have verified, but what is the limit, what is the amount which is admissible under this particular section, that also needs to be carefully taken care of by the carefully looked at by the tax auditor. Okay, clear? Now, before we move further, We will pick up some examples. Okay, if you remember in the last session, we discussed that we are planning to cover some more examples on the basis of all of these clauses that we have discussed so far. And I'm assuming that you would have revised, you would have gone through all of these provisions. Okay. Okay, so let's look at another example now. Say this is in the context of MNO Private Limited. So it's a company. Now this company had got actuarial valuation for gratuity. Yeah. And let's assume that this company is covered under Ind AS. This company is covered under Ind AS, and the actuarial valuation which has been carried out, which has been covered by the company, happens to be as per Ind AS only. So this is as per the required parameters. Now, the total liability of this gratuity or this provision for gratuity, let's suppose happens to be rupees 59 lakhs. And during the year, payment has been made to the extent of rupees 19 lakhs. This is during previous year. And rupees 10 lakhs has been paid subsequent to the previous year, but after the but up to the date of return of income. So this is up to due date of ITR, and rupees 5 lakhs has been paid. Rupees 5 lakhs has been paid after the due date. Yeah. This has been paid after due date. And now in respect of gratuity, there's a confusion in the mind of the management. So management has requested the tax auditor to comment on this point. Yeah, though they have put down this information in Form 3CD, but it is up to the tax auditor to check and assess as to which amount will be reported over here. Okay, this is number 1. Number 2, for MSME, for MSMEs, yeah, small, medium-sized enterprises, the interest which should have been payable was rupees 2.39 lakhs only. This was immaterial. This was immaterial, and hence and hence no such amount was recorded in the financial statements. So this was not recorded in the financial statements. In fact, I should say this was recorded, or let's make it not recorded. So this was not recorded in the financial statement. So that means the profit which was reported, that was after this, or that was before this. Now the tax auditor wants this amount to be reported over here. Now the tax auditor wants this amount to be reported under this form number 3CD. But the management has a request. Management is saying that if this amount is reported in form 3CD, then such an amount will be disallowed by the ITO, income tax officer. Why? Because he would assume that this is the amount of interest which has been taken to the books of accounts, and therefore this should get reversed. Okay, because this amount is not allowed while computing the taxable income. Okay, so now in the given situation, how should the tax auditor deal with this? So in this case, management doesn't want to report in form CCD. Alright. So these are the two matters. Okay, and I think we can bring in one more point. So these are two matters, and let me just bring in one more point over here. There were certain transactions with specified persons. Okay, specified persons are the one which are in the bracket of related parties. That clause we discussed. Okay, 48.2. There were certain transactions with specified persons. And those transactions actually met the criteria as per Ind AS. Those met the criteria as per Ind AS as well as 40A2. Now in this case, the tax auditor understood that reporting of these transactions means the disclosure of these transactions was missed in the financial statements. Disclosure in financial statements was missing. Now the management has a point. Management is saying that everything which goes into Form 3CD has financial statements as the basis and which is also audited. So even if it is missing, this is an audited set of financial statements. So when the tax auditor wants to cover anything in Form 3CD, that should align with the audited set of the financial statements. But tax auditor seems to have a different view. He thinks that even if it's not disclosed in the financial statements due to any reason, he would want these transactions to be reported under Form 360. All right. Now, on this point, there's a difference of view. Okay. Now, for all of these three situations, you may now tell me one by one, how should we really deal with them? Correct? Clear on this? I can see some queries from Sumit. Sumit, I'll come to your queries. And let me just take you to the board also. Sorry. Okay, I'm just hoping the facts are all understood. I'll just quickly repeat. So first is about actuarial valuation, which has been done as per Ind AS. 59 lakhs was the total amount. 19 lakhs paid during the previous year. 10 lakhs paid up to the due date of furnishing ITR and 5 lakhs after the due date. And there is no clarity as around what amount is required to be reported in Form 3CD. For MSMEs, rupees 2.3 lakhs, 2.39 lakhs has not been recorded in the books because this was immaterial. But the auditor would want to report this. Management has a point, if this gets reported, then unnecessarily this will be disallowed. And this anyways doesn't form part of P&L. So this will be like double impact to them in terms of tax computations. And third is about certain transactions with the related parties, which should have come as per Ind AS as well as income tax requirements. But that disclosure was not found in the financial statements, and which now the tax auditor wants to report in Form 3CD, which the management doesn't agree. Management is thinking that all of these transactions or any of these reporting requirements in Form 3CD has the base of the financial statement. So if the financial statement doesn't contain anything, yeah, and which is audited by the statutory auditor, then we should not really be going with this. So let's look at the options. Number one, for the actuarial valuation, I think the correct amount to be captured over in Form 3CD will be 19 plus 10, 29 lakhs. Okay, so full amount will be shown, out of which 29 lakh will be shown as paid. So full amount will be shown, then 29 lakhs as paid, and the balance will be shown as unpaid. So this is for first point. For second point, I think the management has a fair point, and to unnecessarily report in Form 3CD will lead to a problem to the management. But at the same time, there's no doubt that it's a mandatory reporting requirement under Form 3CD. So that's why auditor can get this reported, but auditor should include a note around this, so that when the ITR is considered, it has this appropriate note that this amount has not been recorded in the financial statements. So that means it will go to Form 3CD with a note. Number 3, transactions with specified persons. I think here to say that the financial statements will become the basis will be incorrect, and the basis, if that happens to be the financial statements, even though those are audited and we understand something is missing over there, but the tax auditor believes that should form part of the form 3CD, then such an amount is required to be captured. Okay, so report these transactions. So this is option number 1. Option number B. So for first point, I think 19 plus 10 plus 5. So this is 34 lakhs should be the amount. And of course, full amount will be shown, 34 lakhs as paid, and the balance is unpaid. So this can be the basis. Number 2, it is very clear that interest is only 2.39 lakhs. First of all, that was not only immaterial for the statutory auditor, but also for the tax auditor. Tax auditor also needs to look at some materiality. He cannot just get into anything. So amounts as small as 2.39 lakhs is something which he can easily ignore. So he should not really be getting into it. Number 1. Number 2, even if he wants to go with this, there's absolutely no point, because this is only about creating problems from the management. Unnecessarily, they will end up paying tax on this 2.39 lakhs. So therefore, this should not get reported. Not to be reported. For this point number 3, I think reporting point is valid. So these transactions should be recorded. So this point is similar to what we had in point number 8. Report these transactions. Okay, B. Moving on to C. On C, we can say that the amount to be showed as paid should be 19 lakhs. And of course, full amount will come, out of which 19 lakhs is paid, and the balance will be taken to the next year. For point number 2, this should not be reported because this is unnecessarily troubling the management. Okay, and anyways, this amount is insignificant. So whatever is the response in B, that should be the response in C. For point number C, for point number 3, to report these transactions will not be in line with the requirements of tax audit. Why? Because for Form 3CD, audited set of financial statements, and forget audited, set of financial statements becomes the basis. Why? Because that's the document of the management. If the management is preparing the financial statements, then they will also make financial statements as the basis. Otherwise, it will lead to unnecessary confusion, isn't it? This will create confusion. So that's why this should not really get captured. Why? Because if the auditor has not considered, the statutory auditor has not considered the need to report all of these transactions in the Ind AS set of financial statements, then of course there's no point getting into this now in Form 3CD. So this should not be reported. Okay, option number D. And you can just start evaluating all of these options. All of you. You can just start evaluating all of these options and keep letting me know as to what is your response around each and every option. Option number D. for option number D, we can say that for the purposes of Form 3CD, to pick up the base of this actuarial valuation as per Ind AS would be incorrect. Why? Because there are a lot of differences between the requirements of Ind AS and income tax. So that's why for the purposes of Form 3CD, this gratuity should be computed in a different manner. So the very basis of computation of gratuity is wrong. Yeah. So this needs to be recomputed as per Income Tax Act. And on the basis of this recomputed amount, then all of these balances will have to be considered. Balances which we derive after making the payments, etc. And the payment in such a case will be 19 plus 10, 29 lakhs. Payment will be 29 lakhs. Number 2. 2.39 lakhs is an immaterial amount and which has not been recorded in the financial statements. But in this respect, there's no denial of the fact that this amount was not only required to be recognized in the financial statements, but a disclosure for this was also mandatory in the financial statements. In fact, on the face of the balance sheet itself, there's a separate line item about MSMEs, which is not limited to interest, but if that has been a disclosure, it appears to be a very, very significant one. So that's why whether it is reported or not in Form 3CD, that's a separate matter, and which is actually important. So it's not only about reporting in Form 3CD, it's also about revisiting the entire set of financial statements. Which means that for the purposes of tax audit, because the tax auditor will also be sharing the set of financial statements along with his audit report, this complete set will go. So that's why he should bring out this point in his audit report very clearly, that there's been an error in the financial statements in respect of this interest amount. Okay. So reporting in Form 3CD will be required, and reporting in Form 3CA also required. This is 3CA. That is also required. On point number C, I think this is a valid point, that it's not only the financial statements which will become the basis. It's also about audited set of financial statements that should become the basis. Okay. And once again, if the tax auditor believes that all of these disclosures were important, then he should make sure these are reported in Form 3CD. So he should report in Form 3CD. But at the same time, because somewhere in his audit report, he will be specifying about the financial statements. So that's why he should also be commenting about missing disclosure. So that means he should also report about this matter around the financial statements in Form 3C. So that means he should report in TCA. Okay, so we have these four options available, and I think Sumit would like to go with option number D. All of you can also. Ambika wants to go with option number A. Okay, what about others? Yes, so we can move on to the responses. Kriti also wants to go with option number A. Okay, so we can now start evaluating all of these options one by one. Okay, Mahesh has chosen option number D. So it seems that you are very clear that options have to be A or D. That seems to be the responses so far from all of you. Okay, so let's look at option number B and C, which doesn't seem to be opted by any of you. In option number B, the amount which will be reported is capturing all these three. So the amount which has been paid after due date, is that required to be covered? No. So that means option number B is wrong. Yeah. So I don't really need to look at these 2 points, 2 and 3. Why? Because with this one only, we are sure that this is wrong. Okay, so I'll take out this option. Option number C says that the amount which has been paid during the previous year. But if you look at the requirements of 3CD, it also requires you to capture amount which is paid after the end of the previous year, but up to the due date of filing ITR. That is in respect of 43B. So that means option number C also would be incorrect. Yeah. So this option also goes off. Now we can check about option number A and option number D. So moving on to option number A. Option number A says that 29 lakhs should be reported as paid. So that means 19 and 10, which is correct. And same is the case in option number D. But if you look at option number D, it says that the amount of gratuity needs to be recomputed. So the very basis of gratuity computation has been challenged. But let's try to understand the logic behind this. The logic is that it's been computed as per Ind AS and which is not accepted by the income tax department. So let's think about it. If an amount has been computed as per Ind AS or Indian GAAP or say Ind GAAP, income tax department is disregarding any of these amounts, irrespective of the GAAP. Why? Because income tax department is saying that I will allow this amount only on cash basis. So would it really matter that it's been computed as per Ind AS or some other GAAP? No. Okay, so that means this recomputation, which is required in this case, is not really relevant. Number one. Number two, if we have to compare point number two. Point number two says that we should report this amount. So there is no doubt it's a mandatory reporting. So this should go to Form 3CD. But at the same time, because this should not really lead to a duplication, so that's why a note should be included over here. So that the recomputation, so that when the income tax is computed, that will not unnecessarily lead to a duplication in terms of disallowing this amount, because this anyways is not appearing in the financial statement. So the P&L is, or the profits are increased to the extent of this amount, and in respect of this amount, if this gets reported in Form 3CD, then the department will further disallow this amount. Okay, so that's why the better thing will be to report this, but when it is reported, a note can be inserted to clarify this. In this respect, now the auditor in option number D is thinking that the audited set of financial statements doesn't capture this. This is missing, and that's why tax auditor should report such matter in his audit report, means Form 3CA. Now, would it be appropriate? The answer is no, because in Form 3CA, tax auditor is just simply taking the audited set of financial statements and just specifying. So he's relying on the audited set of financial statements. In fact, I should not really say that he's relying. He's just mentioning that it's been audited by some other auditor. He's not taking the responsibility anywhere in his report about the audit of the financial statements. Okay. So what's the need of commenting on that set of financial statements on which audit is not done by him? Because if that is the case, then he should really be moving to Form 3CB instead of Form 3CA. So that means there again, the reporting requirement in Form 3CA doesn't seem to be in line with the requirements of tax audit. Okay. So that means it appears that option number D is not correct, but still for option number A, we need to check point number 3, whether point number 3 is correct or not. Point number 3 says that you should disregard the audited set of financial statements, in the sense that if something is missing in those financial statements, but those are appearing in the books of accounts, then on the basis of the books of accounts and on the basis of the audit procedures performed by the tax auditor, such transactions, such amounts or such balances should be reported in Form 3CD. Auditor cannot just simply say that these are audited set of financial statements, so anything which is missing over there will also be required to be missed in Form 3CD. That will be incorrect. Okay, so that's why what should be the correct option in this case? In this case, the correct option should be option number A. And option number D should not be the option over here. Okay. Therefore, we can say option number D will not be the correct option. All of you clear? Now I'll come to the queries of Sumit. Sumit is saying only the deductions which are allowed to be reported, which are allowed, are required to be reported. Yes, of course. So the deductions which are allowed means all the deductions which are in the nature of, if you have to go to this clause number 33, just give me 1 minute. And let me also take you to this clause number 33. When you say only the deductions which are allowed, means all of those deductions which are eligible as per this section of the Income Tax Act, that will be required to be reported over here. Okay. Then Sumit's next query is, he's saying since that amount relates to MSME, it has to be, so I think he was talking about the response. Okay. And as regards these clauses, etc., I'll get back to you towards the end of the session of this. Okay, so we can now move further on to the requirements of tax audit. Moving on to clause number 34. So let's understand this requirement. It says whether the assessee is required to deduct or collect tax as per the provisions of Income Tax Act. If yes, please furnish those details. Whether the assessee is required to furnish the statement of tax deducted or tax collected. If yes, please furnish the details. Next, whether the assessee is liable to pay interest under section 2011A or section 206C7. If yes, please furnish the details. Okay, so these are the requirements, and we can understand all of these requirements in a better manner by going through this attachment. So we can move on to these attachments. Number 13 and 14. Okay, so let's try to understand. So if you look at this particular annexure, you will see, first of all, the section is given. Okay, so TAN number, of course, is required, but I'm saying the section is given under which tax would be deducted. So it's about TDS. Okay, tax deducted at source. Section under which tax would be deducted. So this is the first column. Then it says total amount of payment or receipt of the nature specified. So it talks about the gross amount on which tax is required to be deducted. Next, total amount on which tax was required to be deducted. Next, total amount on which tax was deducted or collected. Next, amount of tax deducted or collected out of this. Okay. Next, total amount on which tax was deducted or collected at less than specified rate out of 7. Next, amount of tax deducted or collected, then amount of tax deducted or collected not deposited to the credit of the central government. Along with this, I'll also take you to next attachment, and then we'll discuss about both of them. So let's understand this requirement. It talks about details of tax deducted or collected furnished. So what was the due date for furnishing? What was the due date, the actual date, and whether the statement of deducted or collected has been furnished or not. Okay. Now I'll come back to this particular annexure. So let's try to understand what is the requirement over here. This particular clause happens to be the clause which is at times onerous in nature. Once again, this is a clause which would require significant efforts on the part of the auditor. And let's try to understand why. It says that all the payments on which TDS is required to be deducted, whether those payments have been made or whether the TDS has been deducted on all of those transactions or not. Now, in this case, it's not only required to comment whether the TDS has been deducted or not. It is also required to comment if the TDS has been deducted, whether that has been deposited or not, and that too on time. If you remember, in some of the previous clauses, we talked about deposit of TDS, whether the TDS was deposited on time or not. Remember? Yeah. In this clause, the effort of the tax auditor increases significantly. Just give me 1 minute. For a company, let's try to think about some of the transactions. And we'll look at few examples to discuss this. Say transactions with contractors. One is transactions with contractors. Second is salaries which are paid. Salaries which are paid. Third, we can say interest payments. Next, we can say rent, and so on. On all of these transactions, tax is required to be deducted when the payment is made. Yeah, I'm just hoping that you would be knowing about the provisions of TDS. So I'm not getting into the details around the provisions of TDS. In respect of this, the auditor is required to check that if any such expenditure, any such service, or let's suppose for goods also, wherein we have TCS, if any such transactions took place during the year, whether the TDS was deducted or not. So I would say TCS was deducted or not. Deducted or not. So this is the first point. And if this was deducted, whether it was deposited or not, and that too on time. Deposited or not, and that too on time. So all of these things are required to be checked by the tax auditor. So let's try to understand the challenges over here. Now, what could be a challenge? Or what could be the requirement in respect of this type of checking? First, if you look at such type of transactions, to check whether the TDS is deducted on each and every transaction may not be easy. This may not be easy. Let's think of a company which is into service sector, or let's think of a company which is not into service sector, but which, let's suppose, has got huge operations, or even if those are decent, or in terms of operations, let's suppose a company is a decent sized company, wherein all of these transactions will be significant, means the volume will be very high. Now in this case, there could be hundreds of such transactions. In fact, this may not be really hundreds, thousands of such transactions during the year. And for large companies, these could be lakhs of transactions. Okay. Now to check whether TDS has been deducted on each and every transaction or not, how will the tax auditor check it? Will it be possible for the auditor to check whether the tax is deducted on each and every transaction or not? See, this part is easier for the auditor to comment, because if the TDS is deducted, then it has a due date. After its deduction, if it gets deposited on due date, it's fine. Okay. After its deduction, if it's get deposited on due date, it's fine for the easier to track. It's fine for the auditor to track, because he would be knowing as to when it would become due. Correct? But if the TDS is not deducted at all, what's the basis for the auditor? Because if the auditor has to review each and every transaction, then he would not do anything beyond this tax audit throughout the year. So he'll end up doing tax audit only, and there again we are not sure whether he will be able to end his tax audit or not on time. So very, very difficult for the tax auditor in such a case. Correct? And some of the transactions like salaries. So if you look at these type of transactions, the rate is at least fixed. So there is a specified rate at which TDS is required to be deducted. But if we talk about salaries, there is no fixed rate, isn't it? So how will the tax auditor check it? So this requirement, which came sometime in around 2015, okay, when this guidance note, etc., were introduced in terms of revision, this requirement kind of became onerous for the auditor, and that's where the guidance note specifies that in respect of these transactions, the auditor will be performing this testing on a test check basis. Okay. But there's one point which cannot be ignored and which is a big problem, and that is about completeness. As we all understand that audit is based on various assertions. So as regards the deduction of TDS, we can just say that, of course, we pick up few sample transactions, and on the basis of sample transactions, we can check whether the TDS is getting deducted or not. But to comment whether the TDS has been deducted on the entire amount, on the full amount or not, is not possible by doing sample testing. And 100 testing anyways is not possible. So let us take an example. I'll just pick up only two. Say one is contractual services. Let's suppose second is salaries. Say over here the amount is 29 crore. And for salaries, let's suppose amount is 13 crore. Okay. Now in this case, what is that procedure that tax auditor will perform, on the basis of which he will be able to check, he will be able to verify whether the TDS has been deducted or not? TDS deduction. So first is of course test check. Sample testing. Second procedure which will help the auditor in respect of completeness. Completeness means whether on this full amount the TDS which should have been deducted has been deducted or not, will be possible through reconciliation. See, these days, if the companies are using packages or the decent IT packages, we can say it will be fair on the part of the tax auditor to look at those reports, and on the basis of those reports, which will get generated from the system itself, with the total amount of the expense or this or whatever we have this. Second will be to check as to what is the amount of TDS which has been deducted. So let's suppose in this there are thousands of transactions. So all of these transactions are listed down, and on which TDS is also coming out separately. So if this happens to be a report generated from the system, it's easier for the auditor to check. But let's suppose if there are no such reports available, then what can the auditor do? Number one, he can compute the TDS on this entire amount. Let's suppose TDS is required to be deducted at the rate 2% on this. Let's not go with the rates which are applicable right now. It's only illustrative for our purposes. Let's suppose TDS has been deducted at the rate 2%. Okay. Now, on this total amount, what would the auditor do? Auditor would also compute 2%. Yeah. And when this 2% will be computed, he will check in the TDS ledger that whether the TDS on account of this is coming out to be 2% or not. If that is 2%, then it's kind of reconciled and it's also completed. So he will have this completeness testing done that on this entire amount, TDS has been deducted at the correct rate. But let's suppose if as per this 2%, the amount which should have been deducted comes out to be higher, but actually the TDS has not been deducted at that amount, it's been deducted at lower rate. Now what will the auditor do? That becomes a kind of reconciliation. And there could be reasons for this. What can be the reasons? Let's try to understand. One, maybe there were certain transactions which were below a particular threshold. For example, there's a threshold of 30,000. So if transaction with a particular party is below 30,000, no TDS is required. So there could be hundreds of parties which are below that threshold on which TDS has not been deducted. Why? Because it was not required to be deducted. Now, when you look at this total amount and apply 2%, it may not come to be 2%. So where will this go? It will go to those categories which are exempt. Second, it may happen. Now, once again, because these are the books of accounts and errors are possible. Errors are possible in the books of accounts. So it may happen that in the books of accounts, some of the transactions or maybe a couple of transactions of rent got recorded under this head, on which the rate of TDS is 10%. So when we are computing 2%, actually this amount should have been lower, but it's coming out to be higher. Yeah, but there were certain exempt amounts because of which it's not coming out as a very significantly higher amount. So this can be another reconciliation. When you look at all of these reconciliations, in all of these cases, auditor is not really looking at each and every transaction. Auditor is just looking at the basis to ensure the completeness, or this completeness as around deduction of TDS on this entire amount. Correct? Clear on this? Now, these are some of the procedures which the auditor would follow, which the auditor would perform, or would be required to perform to ensure whether the TDS has been deducted or not, and whether the TDS has been deducted at the correct rate or not. And if there are any such reconciliation differences, auditor would straight away take those differences to Form 360. So all of those amounts will get reported in that annexure which we discussed. Okay, clear? All of you? Yeah. So now what I'll do is I'll pick up few examples based on this sort of reconciliation or this particular type of procedure, which you can then answer. Huh? So let's look at one more example now. And if you'll understand most of these things which we have discussed in the form of examples, you would have found that most of these things require knowledge of income tax. So that's why if you are anywhere not having an understanding of that income tax, then definitely it may become difficult for you to answer. Okay. So now we are talking about a company, say IMN Limited. Now it's about procedure regarding deduction of TDS. We are limited only to that. Now during the course of audit, auditor found and observed a couple of things. Number one, certain expenses like rent, interest, salaries, okay, these got capitalized. So the company has a project going on which all of these expenses were directly attributable to that project. And because these were directly attributable to those projects, so that's why part of these expenses got capitalized. We can say approximately 40% of expenses under these heads got capitalized. Okay. And this is something which the management knew. So they had an identification of these expenses. And the 60% were taken to P&L. And you need not get into the accounting requirements, because as per the accounting requirements, it was all fine. Number one. Now in this case, TDS, which reviewed by the auditor in terms of its deduction, etc., showed following responses. TDS was not deducted on this, TDS was deducted on this. Its deposit was on time. So this was not required, this was on time. So I can say timely deposit, yes, it was timely deposited. Okay. And this is something which the auditor has checked. So he is happy with this. So there is no problem on this. So this was first point. Second point on which the auditor has got a problem. Let's understand that. Auditor found that there were certain transactions. Let me just pull out which all transactions are possible over there. Auditor found there were certain transactions which were in the nature of consultancy. So we can say consultancy services. Okay. Now, in respect of these transactions, auditor found that the invoices for these services were received late. Many times these were received late. Okay. And whenever these invoices were received, these were booked by the company, which should have been booked earlier. So let's suppose if an invoice was received in the month of April. Sorry, let's suppose an invoice was received in the month of June. It belonged to April, so this was recorded in June. Okay. So it was invoice was received in June, on which TDS was also deducted in June, and this was deposited in July. So this was on time. Okay. So as regards its deduction and deposit, there was no problem. But tax auditor has a problem around the booking of this expense. Tax auditor is of the view that this amount should have been booked in April. Expense should have been recorded in April. Okay. Now let's try to understand this problem, because it's a very difficult situation for the auditor and the management. Now the tax auditor is saying that looking at the books of accounts, TDS has been deducted on time as well as deposited on time. But if you look at the accounting, the way accounting has been done, it's wrong. Why? Because if this expenditure would have been recorded in April, then the TDS is required to be deducted on accrual basis. In such a case, TDS would have been deducted or should have been deducted in April, and which should have been paid in May. Yeah. Currently, if you look at the books, TDS deduction and deposit is correct, but the way accounting is done, we can say TDS is wrongly deducted and wrongly deposited. But this is the practice which the management has been following over the years. So it's not the current year. Management is saying that they have been operating, they have been running this company for around 20 years now. And all this while tax audits were performed, all this while scrutinies of their income tax returns, etc., took place. And this was never objected to by any of these parties. So this is unnecessarily a problem which is being created, and there's a practical problem behind this. management is saying that for them to accrue this expense in April, they don't have any basis. Why? Because they don't receive the invoice. Only when they receive the invoice, they will get to know about the amount. And let's suppose even if they accrue in April, let's suppose if they accrue in April, so what will happen? This will be estimated. On an estimate, management is asking the auditor, do you think we should deposit TDS on an estimated amount, which will keep changing, and then next month we should revise it? Unnecessarily, we'll just keep depositing it and revising it, which will lead to challenges and unnecessary communications, unnecessarily notices, etc. from the income tax department. So they don't want to create any complications. They are saying it's very simple, very easy, which has been going on, and we should not trouble it. Okay, yeah. Further, the auditor found that in certain cases, this problem also arose for interest expenditure. Why? Because the management is paying interest to certain related parties. So if they have been paying the interest to unrelated parties, means to the bankers, etc., it's all paid on time, deposited, etc., is all time. But as around the interest expense to related parties, as and when they want, they pay interest, and by the year end they ensure that the exact amount of interest is paid, and this again is subject to the same problem like in case of consultancy. So auditor wants that the interest should be recorded on an accrual basis. But management again has a point here. Management is saying that you should look at the financial year. And this is absolutely correct. In respect of the financial year, there's nothing which the management has not recorded. Everything related to the financial year is recorded in the financial year itself. So management is saying if you look at this entire financial year, everything has been recorded and everything has also been deposited. It's only about month-on-month problem within a financial year. So management would have appreciated the point of tax auditor if this was going beyond a financial year, which is not the current case. Yeah, but the auditor is not agreeing with this. Auditor is saying that if this is not corrected, then the auditor will have to report this matter in his report. And of course, he wants this matter to be taken to Form 3CD. So now for both of these situations, we need to comment that how should the management and the tax auditor deal with both these things. Do you think that this first point is all okay? With which tax auditor is fine, absolutely fine. And around this second point related to consultancy and the interest expense. Okay, yeah. So I'll just clear this part to create some space for options. See, as regards point number 1, everything is okay. Auditor is also okay, management is okay. So let's not disturb this. For point number 2, we believe that the argument of the auditor is not valid. Yeah. So the current practice should continue. Current practice should continue. So this is option number 1. Option number 2. 1 is okay, but as around point number 2, the current practice is not okay. Auditors observation regarding deduction of TDS on accrual basis is correct, which doesn't seem to be happening, even though it appears that it's getting deposited on time, deducted on time, but actually it's not. Actually, the way accounting is done, the expense is not getting recorded on time, and that's why TDS is also not getting deducted on time, which is not right, and that's why the reporting in respect of all of these amounts should be done. Okay, now on point number C, on this point number 1, actually, if we look at the in TDS, there's one thing which has been missed by both management as well as the auditor. What? That they have been fine in deducting the TDS on all of these amounts which is going to P&L, but something which is not taken to P&L doesn't mean that the TDS will not be deducted on that. TDS should also be deducted on that, and that's why to that extent the management has done wrong, and the auditor has also not been able to capture it. So that's why this matter should also get reported. So report known deduction. As regards point number 2, I think the current practice should continue. Okay, so we can just pick up this option from A, that current practice seems to be okay. Because this is practically fine. Why? This is because of the fact that it's not only about the observation of the auditor. In the past years, it was not only a single auditor. Various auditors came and they looked at all of these things and they never commented on this. Secondly, all of this tax audit is for whom? Income tax. When the company has been subject to scrutiny, and during the scrutiny also all of these points have not been raised by the income tax department, then why to complicate this unnecessarily? Correct? Yeah. So that's why this seems to be completely fair on the part of the management to not get into these practices or the change in practices which the auditor requires. Option number D is to change everything. Means 1, report non-deduction, which doesn't seem to be in line with the practicality of the things. Number 2, reporting should be done. So option number D seems to be looking at only the theoretical aspects, forgetting about practical scenario for the management. So now over to you. Which option do you think will be the correct one out of these? And you can also share your inputs as to why you would want that option to be chosen. And so with this thing, sir, in point number 1, these expenses are wrongly capitalized? No. So as I told you, capitalization is all okay. Capitalized as per the GAAP. Capitalization has been perfect. So management has done it right, audited, all okay. So there is absolutely no problem in the capitalization. It's all okay. Jay would want to go with option number C. Okay. And any more responses from your side? So we'll also move on to evaluation of all of these options now one by one. In the meantime, if you want to share any option, you can just share that. Yeah. Okay, so now moving on to option number A. First of all, to say that the current practice of not deducting TDS in respect of amounts which have been capitalized will not be correct. Because once again, we need to understand the provision of income tax. It doesn't require anywhere around non-deduction of TDS if the amount has been capitalized. TDS deduction is irrespective of the way its accounting is done. Yeah. So that's why we can just simply say that option number A is incorrect. And by doing this, we can also say that option number B is incorrect. Yeah. So option number A and B go off. Sumit is saying, so TDS has to be deducted in point number 1, whether it is capitalized or not. Okay, same as our response also. Yeah. Now moving on to option number C, which has been chosen by J. Okay. Option number C says report non-deduction. This has to be the case, and that's why we have eliminated options A and B. So of course, point number 1 is correct in saying this, but it specifies that the current practice should continue. See, just now I told you that TDS provision will not go as per the requirements of accounting. TDS provisions will go the way those are required to be captured. If the management should have accrued an expense, but they have not accrued it, will this be correct? No, this will not be correct. So they should accrue this amount, because if they don't accrue this amount and if they delay accrual of this amount, what is the resultant? The TDS is not getting paid to the department on time due to delay. Yeah. So that's why we cannot say that such practice should continue. This once again needs to be reported. Jay is saying, sir, I would like to go with C because current practice is okay on TDS because it's on payment or credit, whichever is earlier. And of course, capital items are also the one on which TDS should be deducted. So you're right. But at the same time, please understand that if something is required to be accrued and that has not been accrued, and this has been the practice and this has been going on and month on month this has been continuing. So will this not be a kind of interest loss to the department? The answer is yes. So Sumit has gone with option number D, and that is also the correct response as per us. Okay, clear on this? Yeah. So we'll now continue on those points. Moving on to point number 35. So this clause number 35 requires that in case of a trading concern, give quantitative details of principal items of goods traded. And what are those details which are required to be given? Opening stock, purchases, sales, closing stock, shortage or excess. So we can move on to this attachment now, 15. Let's understand this. Details of raw material, details of finished goods. So the opening stock, the nature, the name of the item, the quantity is required to be specified, purchases which have been made during the year, the transfers, sales, consumption during the year, and of course the closing balance. But please understand that this disclosure is required if you start with it says in case of a trading concern. So that means if the company or the entity or the assessee is not into trading, then will this information be required to be disclosed? No. Then this reporting is not required. Secondly, as regards the audit procedures, how will the auditor verify this? This can be verified from the inventory records. First of all, auditor would trace all the opening balances. When we say opening stock, so auditor would trace the opening balances to the closing balances reported in the Form 3CD last year. Yeah, so that will be the first point to start with. The closing balances which were reported in the Form 3CD last year. So that will be the first point. Point number 2. As regards the purchases, as regards the sales, as regards the consumption, etc. If the tax auditor also happens to be the statutory auditor, he would have audited most of this information during the audit of inventory. And if the tax auditor happens to be a different auditor, means not the one who audited the financial statements, in such a case, tax auditor would need to perform the audit of inventory in relation to all of these items. And this extent of audit will not be the one which would have been done in case of statutory audit. It's only for the purposes of reporting this information. Yeah. So definitely the tax auditor would want to get into all of these reports from the systems. But at the same time, he would also want to verify all of these records on a sample testing basis. Clear? Yeah. Point number B. On this 35, then we have point number B, which requires that in case of a manufacturing concern, give quantitative details of principal items of raw materials, which will talk about opening purchases, consumption, sales, closing stock, yield of finished products. So let me just take you to this attachment now. So it talks about, yes, so this is the one, sorry, for this trading one, I think we didn't have this. So this is the one. Yeah, for trading, this was the one, and this is for manufacturing. So it requires that if the company is into manufacturing, then it should give the details of raw material and finished goods separately. And on these two things, it should report the movement. And for this, once again, what will be required on the part of the auditor? He would first of all want to verify all of these opening balances with the balances reported in the last year. Number 1. During the current year, similar to what we saw in respect of this trading concern earlier, he would verify these purchases, these sales, these consumption, closing balances, and all of these records would be available with the management because they would have got all of these things audited during the course of the audit of the financial statements. That means the statutory audit. And during the course of statutory audit, many of the records would have been required by the statutory auditor. So many of that information will also go to the tax auditor if the tax auditor happens to be a different firm or the party. But in this case, once again, the procedures which will be performed by the tax auditor would be limited to the sample testing because he may want to check some of these transactions to identify their nature, whether those are raw material or at what stage they are into, and in terms of purchases, whether the purchases have taken place during the year or not, Most of this information these days are available from the IT systems, or we can say the ERP systems of the entities, wherein all of these informations are maintained, and that is again once again required to be audited by the auditor in terms of reporting under this clause. Okay, clear? Okay, so now moving on to clause number 36. Mm-hmm. 36. In case of a domestic company, details of tax on distributed profit under section 1150, total amount of distributed profit, amount of deduction, total tax paid thereon, and dates of payments, etc. with amount. See, this would not really be relevant anymore, considering that we don't have the tax on distributed profit. But for the purposes of the auditor, how can the auditor verify it? Very simply, auditor can verify it from the books of accounts, wherein he can check if there are any distributed profits or not. And of course, any of the tax thereon will have the challan, and that will also be recorded. So this is very, very easy for the auditor to verify from the records of the company. From this 36A, let's try to understand whether the assessee has received any amount in the nature of dividend, means it's about receipt of that amount as referred to in section 22(2)(e) of the Income Tax Act. If yes, furnish the following details: amount received and date of receipt. Now, once again, all of these particulars, how can the auditor verify it? He can just go to the other income. Most likely the company would have recorded this as other income in the P&L. So in the other income, he can just ensure that all of the amount which has been recorded, whether that is falling under this particular section or not. And if that is falling under this particular section of the Income Tax Act, then of course it will be required to be reported. And in respect of that other income, what is the procedure he will perform? He will verify the underlying documents, the supporting documents on the basis of which he would have, the assessee would have received the amount. Yeah, auditor can verify the bank statement to check whether the date of receipt which is reported over here is correct or not. Clear? Yeah. So we are still left with some more clauses under tax audit under Form 3CD. So what we can do now is we can take a break of 10 minutes, and let me just see in case you have got some queries. Yeah, so I see one query coming from Mahesh. Mahesh is saying, sir, accrual arises only when the service is completed. Say, for instance, the service is not rendered on time by professional, then what do we do? See, I'm not getting into the accounting requirement as of now. So I'm saying if the accounting required that provision to be created, then the provision should have been made. And of course, if that has been accrued, then the TDS should have been deducted. So this evaluation of accounting is separate. And this is not really dependent on whether the service is completed or not and whether the invoice is received or not. Accounting doesn't go by this. All right. Clear on this? Yeah. So let's take a break of 10 minutes, and after this we will continue our discussion. Hi. So we'll now continue with our discussion on this remaining part of the Form 3CD. So the next clause is around cost audit, then certain other audits which become applicable to certain companies on the basis of the requirements of those particular separate sections. So these are not really the sections of the Income Tax Act. These are the separate requirements. But in respect of these audits, if those are required to be conducted, then the particulars of such audit are required to be furnished. So let's understand them one by one. Whether any cost audit was carried out. If yes, give the details, if any, of disqualification or disagreement on any matter, item, value, quantity, as may be reported or identified by the cost audit. So as we have discussed that cost audit is not applicable to each and every company, to each and every entity. So therefore, first of all, it will have to be assessed whether the cost audit was applicable on the entity or not. And if yes, was this subject to cost audit during the previous year or not? And if this was subject to cost audit during the previous year, whether the cost audit has been completed or not by the time this Form 3CD is getting finalized, and the report of the cost audit, has it got any disqualification or is it all sort of clean? Now, all of these aspects are required to be looked at by the tax auditor, for which he needs to have discussions with the management, he needs to have inquiries from them, he needs to also understand the applicability of any of these types of provisions on the company, on the basis of which he will get the required input. Auditor is not required to get into the this cost audit, but of course he can just flip through the cost audit report or any of the observations, etc., which may have been reported in respect of the cost audit. And if there is anything in the nature of disqualification, etc., then that is required to be specified. Now, practically, let's try to understand about this. Practically, the cost audit is required to be completed by 30th of September. So if you are looking at 31st of March, by 30th of September, cost audit is required to be completed. And generally, you will see that the companies will also be required to complete their tax audit by 30th September. Okay. And in many of the cases, companies would be completing their tax audit before the cost audit is already, or that even starts for the current financial year. So that means for the previous year. That's why generally the cost audit report will not be available for the previous year, or that means for the current year. Generally, it will be available for the preceding previous year, and that becomes the basis of reporting under this clause. Okay. But this is again something which the auditor needs to check with the management, inquire therefrom, and accordingly the report about such matter over here. Moving on to clause number 38. Whether any audit was conducted under Central Excise Act 1944. If yes, give the details. If any of disqualification or disagreement or any matter. Similarly, if you look at clause number 39, whether any audit was conducted under section 72A of the Finance Act in relation to valuation of taxable service. If yes, give the details, if any, of disqualification or disagreement. So this is again on lines with what we discussed in clause number 37. This again needs to be assessed by the auditor, looked at by the auditor, and if any such audit would have taken place, which now would not really be applicable considering that we are into GST now. So that's why any of these reports are required to be looked at, and any of the matters which may have been observations of any of these departments are required to be captured over here. And this will again be on the basis of discussions, inquiries with the management, because otherwise no such records would generally be available in the books of accounts, because all the books of accounts which is audited by, say, another party, and which will come to the knowledge of the tax auditor only on the basis of discussions, inquiries with the management. Okay. Moving on to next point, clause number 40. Details regarding turnover, gross profit, etc. for the previous year and the preceding previous year. Now, this is an important information. So let's move on to this annexure to understand about this information. So it requires following information to be furnished. First is the total turnover. Now, in respect of this total turnover, once again, the basis of this total turnover at times becomes a point of confusion. Okay, so that's why you would generally see a note is given at the end. Currently, there is no note because it may be a simple case to handle. Now, whether this total turnover should include other income or not. Many a times companies may want to show their other income as part of this total turnover. So therein a clarificatory note is given that this amount includes other income, excludes other income. Number one. Second is the percentage of gross profit, percentage of net profit, and stock in trade turnover ratios, material consumed as a proportion of finished goods produced. Yeah. Now these informations are required to be furnished, because if you look at the requirements of these information, these help the department to assess, and if you can just compare these two also over here, these would help the department to assess as to what all changes have been taking place in terms of the profitability of the company, in terms of some of these datas, which is about manufacturing cost. Just 1 minute. So I think it's visible in a better manner now. Correct. Yeah. So as you can see, gross profit ratio in the current year has got significantly down. It has gone down significantly. Net profit ratio has not gone down significantly as compared to gross profit ratio. So that means during the previous year, significant costs which are direct, okay, significant direct costs have been incurred, and those have increased as compared to preceding previous year. But at the same time, we can also see that various indirect costs would have gone down, because only then this profitability, this net profitability is not falling so significantly the way gross profit has been falling. Correct? It's an analysis. Now, as regards this analysis, tax auditor doesn't have much to do because all of these numbers are getting reported from the financial statements. So if this GP ratio is going up or down, net profit ratio is going up or down, this doesn't really impact the tax audit. Of course, he may want to know the reasons. He may want to look at some of these items which may have certain reporting requirements, say in other clauses, which may be arising out of these ratios, or some of the information which may be used under these ratios could be based on that. But as regards these ratios, it's only about filling the form, putting the information. In this respect, the tax auditor needs to perform a procedure of tracing all of these figures correctly to the audited set of financial statements. Okay, yeah. Beyond that, he is not required to do anything. If the information in the financial statements is given, that is the basis he will follow for the purposes of reporting over here. Correct? Yeah. These all ratios, though, are very, very important because if you look at some of the assessments of income tax, they use these type of ratios for the purposes of their assessment. Moving further on to clause number 41. Please furnish the details of demand raised or refund issued during the previous year under any tax laws other than Income Tax Act, along with details of relevant proceedings. So if there are any demands raised or refunds, etc., which have been issued, then those are required to be reported over here. And what will be the basis of reporting over here? Now here again, if those demands raised or the refunds issued would have been recorded in the books of accounts, then on the basis of that information which the auditor would have verified from the books of accounts, it will be reported over here. But there could be certain demands raised which may not have been recorded in the books. Why? Because the management may be objecting to that. The refund issued will definitely be recorded and those will be appearing in the books of accounts always. So that will become the basis for the tax auditor. But the demands raised particularly may not be recorded. They may have been kept as contingent liabilities, and many times the management may not have considered that as contingent liability also. So such type of cases are brought to the knowledge of the tax auditor only through the management. So he needs to have discussions with the management, understanding from them. He also needs to go through the legal records of the company, have discussions with the legal team of the company. He can also look at certain ledgers which may be reflecting any of these points. For example, through the review of legal and professional expenses, he would get to know as to what all litigations would have been going on, through which he can have a specific discussion with the management as around any of the documents which he might have obtained, or sorry, which the management may have obtained and which may not have been recorded in the books of accounts. And even if all of these are recorded in the books of accounts, it may not be very easy for the auditor to track each and every item. So that's why, once again, in this case, auditor would need to have discussions with the management to get more clarity around all of these items and accordingly get it reported over here. Clear? Now moving further, because with this we are almost done. So there are some more particulars which are required to be reported. Whether the assessee is required to furnish statement in form 61 or 61A or 61B, and the details around this. Means the income tax department reporting identification number, type of form, due date of furnishing, date of furnishing if this is furnished, where the form contains information about all details transactions which are required to be reported. If not, please furnish the list of details transactions which are not reported. Next, whether the assessee or its parent entity or alternate reporting entity is liable to furnish report as referred to in section 286, and in respect of this, the report has been furnished by the assessee or its parent entity or not, name of the parent entity, name of alternate reporting entity if that is the case, and date of furnishing of report. If this is not due, what's the expected date by which this is required to be furnished. Now, as around these two clauses, these are basically the specific requirements which arise out of Income Tax Act. So once again, this is all about looking at that information first of all on the basis of the evaluation, whether these clauses are applicable to the company or not, or to the entity or not, or whatever the case. And if these are applicable, what will be the due date for furnishing of these forms? So this needs to be evaluated. And there is something which is also called as CVCR reporting, which is more of I would say in line with the transfer pricing requirements. Yeah. So the auditor just needs to review all of those documents first of all to assess the applicability, because if these are applicable and these are not reported as applicable, then this could be wrong on the part of the management. And of course, these are applicable if the management has also considered this to be applicable, and all of these documents have been submitted, then the auditor can just verify all of those documents, and on the basis of the verification of the documents, auditor will be able to comment as to what all information has been captured over here. Yeah. Then this Form 3CD will be required to be signed off. So it's similar to the financial statements, I would say. This is required to be signed off by the management. Why? Because it's the document of the management. So this will be signed by the management. And this will then be signed by the auditor also, similar to what the auditor does in case of financial statements. Okay, clear on this? Yeah. And once this Form 3CD is reported by the auditor, signed off, along with this, what will go? Form 3CA or Form 3CB, as the case may be. In fact, it's a complete set which goes. And as we discussed that this is now all e-filed, this is filed online. So the way it appears to you is more in the form of an Excel, but this actually doesn't go in the form of an Excel. It's an online filing, and the signing, etc., all take place online. Okay, clear? So with this, we come to an end to our discussion on tax audit, and we can have a discussion as around this tax audit with the help of some more examples. But I plan to start GST audit now. And during the course of our discussion on GST audit, we'll just pick up some examples, and wherein I'll just try to mix up some of the things related to tax audit as well as GST audit overview. Let me just look at some of your queries now. Okay, so Harshad is asking about indirect taxes. Yes, of course, we are moving on to that now. No, Harshad. So I don't see any such thing now. So moving on to GST audit. Just 1 minute. Okay, so now moving on to the requirements of GST audit. GST audit, similar to what we see in case of tax audit, is required by the GST department, we can say. Okay, so let me just give you some perspective around it. So let's understand what's the requirement of this GST audit, how does it get generated. If you remember, for tax audit, we discussed that there was a set of financial statements which was audited by the statutory auditor. Yeah, but there were certain differences to move up to ITR, and because of which, and which was one of the reasons why we had this tax audit in place, and at times we saw that the financial statements were not getting audited. Correct? Now, once again, if we see, we have audit of the financial statements, which is performed by the statutory auditor. So I'll just try to keep it in synonyms. Audit of financial statements, which may be performed by the statutory auditor or may not be performed, or no audit in case it's not a company. So in case it's not a company, there is no audit. Okay. But the GST details of each and every assessee are required to be reviewed. Now, what do you mean by this? Each and every assessee. See, if you look at almost every transaction now, it's subject to GST. What is GST? Goods and Services Tax. Almost every transaction. I'm not saying everyone, almost everyone. And the companies which are collecting GST, they are required to pay GST. Similarly, the companies would be paying GST for which they may be availing the input credit of GST. Now, GST department wants those details or particulars of those details to be verified. So how can the department do this? So there is a threshold which they have prescribed. So beyond a particular threshold, every assessee or every entity beyond a particular threshold, every entity is required to file its annual return to the GST department with the particulars which they require. Annual return is required to be filed to the GST department with the particulars which they require. And those particulars which are furnished by the assessee, with that entity, are required to be audited by GST auditor. So what will be the role of GST auditor? To audit those particulars which have been furnished by the entity to the GST department, and for which, once again, there is a threshold, and this threshold is higher. So we can say first threshold is for furnishing annual return. So furnishing annual return is not mandatory for every entity. Up to a particular threshold, it's voluntary. Number one. Number two, there is a threshold which is higher than this, Yeah, higher than this, basis which entity will be required to get the GST audit done. Okay, I'm not getting into those thresholds right now. We'll come to that later on. But other than these two, what we can also see is that on a monthly basis or maybe on a quarterly basis, even if those entities are not falling within this threshold, they would be submitting their monthly GST returns. Yeah. Now, nothing is required in respect of those monthly GST returns as far as the audit of GST is concerned. Nothing is required in respect of furnishing annual return for the entities which are not subject to GST audit. Okay, so let me just put down a layer. Let's suppose 2 crore is the limit. Over and above 2 crore, every entity will furnish annual return. But below 2 crore, every entity will be submitting the monthly returns, quarterly returns. So I'm saying for both of them, this GST audit will not impact. GST audit will impact those entities to which this applies, and that will of course be higher than 2 crore, which keeps changing. And in fact, if we look at the current scenario, it's not applicable anymore from the next financial year. Yeah, but for our purposes, this is applicable. Now, considering the requirement that we have, we can say that even though the financial statements of those entities to which GST audit is applicable, they may have got their financial statements audited. Yeah, still they will be subject to GST audit. They may not have got their financial statements audited. For example, if we talk about property, for example, if we talk about partnership firm, they may be subject to tax audit, and wherein their financial statements would have also got audited. Remember, still they will be subject to GST audit. So that means GST audit is an independent requirement, and this is not really dependent on whether the stat audit or the tax audit is conducted or not. Clear? All of you? Now moving on to the requirements of the GST audit, let's try to understand what does this audit mean and what does this audit requires. So this audit means examination of records, returns, other documents, examination of records, returns, other documents which are furnished by the registered person. Who is the registered person? The person who is registered under GST. And therein its audit will be performed, and in terms of audit, what will be required to be done? The audit will require verification of correctness of turnover declared, taxes paid means GST paid, refund claimed, and input tax credit availed, and to assess his compliance with the provisions of GST law. So all of these things are required to be covered in respect of the GST audit. Okay, yeah. Now let's look at some of the requirements of the GST audit. So this is all about our understanding. So this GST envisages three types of audit. One is the audit of accounts, on which we'll go into details. Second and third, we can say, are the special types of audit. Special types of audits are the one which may be required by the GST authority. Which may be required by the GST authority. So that I would say is the special type. Only when the GST authority will require, those will be conducted. But the first one will be conducted always. Okay. So now moving on to some of the requirements related to that. Now what will be required to be audited therein? GST audit is all about audit of a reconciliation. And what is this reconciliation? It says value of supplies which are declared in the annual return and value of supplies which are declared in audited set of financial statements. Let's try to understand what is this. So once again, I will say there are two sets of records. This is GST particulars, or you can say GST details furnished through GST portal to GST department. GST is applicable on sales of the company. That means on the sales, GST will be applicable. Let's suppose services are rendered by a company. Say a company has rendered manpower services. So what will the company do? Say for example, the service income, the sales of this company is 100 rupees. So it will charge 18% GST on this. It will charge 18% GST on this. And the customer would be required to pay 118. Correct? Now what will happen? In the books of accounts, this 100 will be recorded as revenue. And in the books of accounts, this 18 which will be collected from the customer or due from collection will be customer will be recorded as GST liability. Because what will this company do? Collect this 18 from the customer and pay to the GST department. Okay. So in the books, 100 is shown as revenue. Okay. Now these two particulars are also required to be furnished on the GST portal. So both these things will also go to the GST portal. Okay, clear? Now when the GST department will verify this information, how will they verify this? If they want, for this purpose, they have got this GST audit made applicable to certain entities which are crossing a particular threshold. Yeah. So this is about the information which is there in the financial statements and which is also there as per the GST portal. Next, let's understand what is this reconciliation and why does this need arises. So this first transaction that we discussed was in respect of manpower services. Second, let's suppose some services have been rendered outside India. Okay, or let's suppose company has exported some goods or services. So there have been exports. In respect of exports, the amount is 50, and this 50 will once again be recorded in the books of accounts as revenue. So that means if you look at the financial statement will show 100 plus 50 as revenue. Okay. But on this 50, tax will not be charged. Why? Because GST, let's suppose, is not applicable on exports. So what is the GST? 0. GST is 0. Now when these particulars will go to the portal, what will it show? It will show sales of rupees 150 broken into two parts. 100 on which GST is applicable and 50 which is exempt. Okay. And in totality, 150 will be the sales. And the tax liability which it will show is only 18. Correct? Now in our example, we had only 2 transactions. And that too very simple. So that's why we can just easily compare these two amounts, 150 and 100. So actually, tax has been offered to the GST department on which amount? 100. On rupees 50, tax has not been offered to them. Why? Because no tax has been charged on that. But how will the department get to know about it? Only when this difference is also reported as exempt item or item with 0 taxation rate. So once again, there are a lot of technicalities around it on which I am not getting into. This difference which gets generated between the financial statements and the GST records is required to be reconciled, and that is what is called as reconciliation difference. Okay, so a reconciliation statement is what will flow in the GST audit in terms of the additional requirements of GST audit. So GST auditor will not only verify these particulars, because of course he will audit these particulars on a test check basis, and these particulars he can also pick from the audited financial statements, but he will also audit these reconciliations. In fact, this is the most important area under GST audit, the audit of the reconciliations, because in almost every entity you will see there are some reconciliation differences, and which are for reasons, because the way accounting is required to be done is not the way GST law works. Clear on this? So you can now try to establish the linkage that the same perspective was there in case of tax audit and the same perspective is there now in case of GST audit. Clear on this? Okay, so let's now move further on to this. So this is what we understand in respect of requirement related to GST audit. And before we really talk about the audit procedures, I'll just take you through some of these requirements which we have discussed. So under GST, you will see various returns. Okay. What is the GSTR 9? GSTR 9 is the annual return. The one which is not getting audited. It's the annual return of various particulars which will contain sale, which will contain tax liability, which will contain input credit, which will also contain any refund which is claimed by the entity from the GST department. All of these particulars are furnished to the department by the entity, and this is something which will go from the entity to the department. Auditor doesn't have anything to do with this. Then comes this GSTR 9C. GSTR 9C is basically the document. GSTR 9C, I would say, is the document. Let me just move on to the GSTR 9C. It's the document which requires audit by the auditor. Why? Because this is the document by the auditor and this is the certification by the GST auditor in respect of audit of the GST records or as per the requirements of the GST. Okay. Now, if you look at form number GSTR 9C, what are the various particulars which will move into this? It's broken into two parts. Part A is all about reconciliation statement. It contains nothing but reconciliation. Why? Because if you look at this reconciliation will basically put the entire information into three parts. First part will talk about the information flowing from the books of accounts. Second part will talk about the information which is flowing to the GST portal, means which is furnished to the GST department. And third part will be the differences between these two, if any, and with the reasons for those differences. So it's similar to tax audit. Here again, all of these forms, whether it is GSTR 9, GSTR 9C, these are all forms which are required to be filled online. And the tax audit report, which is nothing but this GSTR 9C, is also something which is filed online. So there's no hard copy in this case. It's all done online. It's all required to be audited online. So there's no portion out of this that you will see is getting produced in the hard copy. It's all completely online form. Now this part of GSTR 9C is something which we need to now discuss in more detail, and we need to now understand in more detail as to what all details etc. will flow over here and what all details etc. will be required to be audited in this case. Okay, yeah. So for this, I'll just quickly take you to this part. This will first of all give you an insight about various parts which are getting reported in GSTR 9C, and then we'll move on to the procedures. Part A is the reconciliation statement and part B is certification. Certification means only the sign off and the certification by the GST auditor. Now on this part A, which is the most significant part in terms of the information which is required to be furnished, it contains first of all the basic details to start with. Basic details about the entity which is subject to audit, and will also once again get into one GST form, live form of an entity, to understand about all of these particulars the way we discussed in case of Form 3CD. Then part B will be about the reconciliation of turnover which is declared in audited annual financial statements with the one which is declared in GST records, means the annual return. Part 3 is about the reconciliation of tax paid, means what is the tax which has been paid as per books, it's 18, and what is the tax which has been shown over here, is that really 18 or something else. Third is the reconciliation of input tax credit. Let's suppose as per the books, income tax credit is input tax credit is say 15 rupees. So whether that input tax credit is also coming over here or not. Clear? Part 5 is about auditor's recommendations. Now during the course of this entire audit, auditor will have some observations, and due to those observations, some of the input tax credit which may have been availed by the entity may go down, may be found to be wrong, the tax liability, the GST tax liability of an entity may come out to be higher, the one as compared to what they had assessed, and any of these reasons may result in additional tax liability on the part of the entity. If that is the case, then the GST auditor would require to comment on that additional tax liability and the way that has been disposed of, means whether that has been paid or not. Yeah, so this is going to be the next part of the GSTR 9C on which the auditor would comment on. Clear? Now for audit of this entire piece, let's get on to the audit approach. So now we'll move on to the audit approach to understand as to what all procedures, etc. will be performed by the auditor. Okay. Now in respect of the audit procedure, let's understand what will be the audit procedure. First will be about planning. Now it's no different from what you see. It's no different from what you see in case of statutory audit. You remember, for statutory audit we discussed 4 stages: planning, execution, conclusion, and reporting. So I would say we can bring out all of those 4 stages over here. All those 4 stages we can bring over here. So what's the first stage? First stage, therefore, will be planning the GST audit. Now, in relation to planning, what all procedures are required to be performed? Auditor would assess the entity, auditor would understand the entity, auditor would understand the nature of the business, auditor would understand the applicability of various provisions of GST in relation to various transactions. In fact, this planning happens to be the most significant part of GST audit. Why? Because as regards all of these reconciliations, etc., they would arise only if the business, the transactions of the entity would have been understood by the GST auditor properly. If the auditor would not have understood any of those requirements properly, then what would he do? He would simply rely on whatever has been prepared and reported by the management to the GST department. For example, let's suppose there are certain transactions of an entity on which GST should have been paid, but the management has not considered paying GST on those departments. Why? Because as per their view, GST is not applicable. As per their view, GST is not applicable on them. Now, let's suppose if the auditor doesn't evaluate the applicability of GST on these transactions, by understanding the nature of these transactions in detail, will he ever be able to comment whether this reconciliation, which would have been reported by the management? Why? Because in the books they have recorded this transaction, but to the GST portal they are saying that these transactions are free from GST. So in such a case, this reconciliation which would be reported by the management, would the auditor be able to comment on this? Would he be able to ensure that this reconciliation is correct? Or if there are some more transactions which should become part of this reconciliation, will the auditor be able, will the auditor ever be able to do this? No. So this requires thorough understanding of the business and the transactions. Number 1. Number 2, this also requires a sound knowledge of GST law on the part of the GST auditor. Because anybody who is planning to do GST audit, if he doesn't know the GST law, will he be able to comment on that? No. Because audit is only possible when you have the knowledge of the underlying item, underlying area which is getting audited. So now in this case, what's that underlying? Underlying is the GST piece or its evaluation as per GST. So that's why that is another very, very important area on the part of the auditor. So it's all about the competence of the GST auditor. Needless to say that over here also, all of the engagement formalities will be performed by the GST auditor. GST auditor would also evaluate whether he would be eligible to perform GST audit or not. GST auditor would also evaluate his independence. GST auditor would also engage in with the management by executing an engagement letter, wherein the terms of his engagement, the scope, each and everything is clearly laid out. And only when all of these things are in place, then he will be able to start the GST audit, otherwise not. Correct? Now, once this understanding about the business, transactions, etc. is all done, what would be the next step? Now the GST auditor would plan his audit procedures. Now it's again similar to what he would have done under statutory audit. He would plan his audit procedures as around various items he would consider important. Now, in relation to the planned procedures, what are the areas that he will focus on? It could be anything. Can we just list down anything specifically in relation to any of the areas? No. That will again be dependent on the knowledge of the auditor. That would again be dependent on the understanding the auditor would have obtained from the management. At times, there could be certain complex transactions which may have taken place during the year. There could be certain positions which may have been taken by the management as regards the GST applicability. Now, all of those positions are required to be thoroughly evaluated by the GST auditor. In fact, under GST, there are various areas on which different positions may have been taken by the auditor. Okay. In case any of those positions which is taken by the auditor is different from the one which the management would have taken, what would be the resultant? What would be the resultant? The resultant would be that the auditor would not be able to then comment whether the GST liability which has been disclosed, which has been paid off in the GST line in the annual return is in line with what should have been done, and that would eventually result in more tax liability. Okay, and which will go out as his comment then, that this liability is not considered to be appropriate for him. Okay, clear? Yeah. Now, this will become the basis for the audit procedures, and then comes the execution piece. Then comes the execution piece. Now, as around the execution, what is it that the auditor will plan? It's about the performance of all of those audit procedures which he would have planned. Now, during the performance of these procedures, as is done in the case of statutory audit, he may have to revise some of his audit procedures. He may have to just revisit some of his audit procedures. He may have to increase his extent of testing. Maybe the books of accounts that he's auditing on may not have been audited. Maybe the audit of the statutory audit is going on and the GST audit has also simultaneously started. So in such a case, will he be able to place reliance on those records? No. He will have to increase the extent of his testing. Maybe the audit is complete, but still we find a lot of problem areas during the course of GST audit. There again, his extent of testing will increase. And this again will be impacted by the IT environment of the entity. This again will be impacted by the control environment of the entity. If the entity would have strong controls, if the entity would have controls which are operating effectively, now this once again would be visible to the GST auditor, because he would also understand all of these things from the management. He will not be required to get into the control testing in case of GST audit, but of course, on the basis of his discussions with the management, he would get to know whether the company has implemented controls or not, and whether those controls would be working, operating effectively or not, because some of the sample testing, etc., which the GST auditor would do, all of these reconciliation statements which the management would have prepared, and all of the differences which would be reflected in the reconciliation statements in the annual return and the financial statements would throw a light on the controls, would throw a light on the pattern, the way management has been carrying on these reconciliation statements, and that would be the level, or I would say that would be the basis which would give the additional comfort level or some comfort level to the GST auditor. And depending on that, again, what will happen? He will have to plan his testing. He will have to plan the extent of his testing, which may can then be increased or decreased. During the course of the GST audit, certain areas around IT environment will also have a bearing on the procedures of the GST auditor. Let's try to understand how. In case of a GST audit, in case the IT environment of the company is implemented in a strong manner, for example, most of the things are automated, or say many of the reports which are generated and used for furnishing the details around GST are automated, then the auditor would again be focused on the audit of the systems or the audit of controls around those systems rather than manual checking. Secondly, if those are generated from the systems, if they are not involving any manual intervention, then the comfort level of the auditor will increase. There's no denial of the fact that even in such a case, auditor will be required to perform his procedures as around those system generated reports. But definitely the manual intervention is something which will cut down the comfort level of the auditor. Correct? These days, most of the companies use various softwares. Various portals are used by the companies in respect of reconciliations which are prepared, in respect of returns which are filed on a monthly basis or on a quarterly basis. And many a times it's been seen that even though this entire process is carried out through various softwares or is considered to be automated, but still a lot of manual intervention takes place. And the moment the manual intervention takes place, the auditor needs to be just looking around the procedures around those manual interventions, particularly as to what was really the need of those manual interventions. Was it that there was certain lacuna in the reports which were generated, or maybe in the logics behind those reconciliations, or was it because the management intended to make any changes? That's why they have done this. Secondly, the pattern in which the management would have carried out their compliances throughout the year. Means they have been very compliant in furnishing their returns. All the returns, etc., have been filed on time. There have been no delays. There have been no penalties, etc. And there have been no inquiries sort of from the GST department in respect of this company. So this will also give the auditor additional comfort as around various audit procedures he would perform. Okay. Yeah. Next, and of course, will be to identify those areas which will have reconciliations. So, for example, one area we discussed, exports. Similarly, auditor will also verify all of those areas of reconciliations. Auditor will also verify those areas which may have reconciliation difference. Now, this reconciliation difference could not be only limited to sales. This could be the one which is related to GST liability. This could be the one which may have an impact on the GST input credit. Yeah, so there could be a whole lot of items which may have a bearing on this, and that's why it's important for the auditor to look around all of those items, to identify all of those items. Even if the management may have missed out, it may be the responsibility of the auditor to get into all of those details, to understand, and if some of those reconciled items have also been missed out, then to bring it over. Because at the end, auditor is also required to report on if there is any additional tax liability. And if there is additional tax liability, then whether that tax liability has been paid off or not. Okay, clear? Because if any of these things is missed by the management, then the auditor may want to bring out that matter in his audit report in the form of a qualification. Yeah, so it's similar to what you see in case of any other audit report. Clear? Yeah. So now what we can do is we can just move on to actual form, and let me just go to your queries first of all. And after having a discussion as regard those queries, I'll take you to that form, and on the basis of that form, we'll start discussing the procedures around it. Sumit is asking, sir, UDIN is also required to be generated in case of Form 3, of course. See, now any attestation work will require UDIN to be put in. Mahesh is asking, sir, place of signing, how is that required to be done when place of location changes? What do you mean by this? So wherever the auditor is placed, he will put that as the location. So when you say place of location changes, what do you mean? Jay is asking, sir, can the GST auditor file monthly GST return, GST annual returns also? See, as I told you, the independence is one area which every auditor needs to be aware of. And that's why all of these things should not jeopardize the independence of the GST auditor. And that's why he should not really be doing this. Harshad is asking, sir, if the aggregate turnover for financial year 1920 is 4 crore, so no GST audit is required. And if for financial year 1819, if turnover is 4 crore, GST audit is applicable as the, so I'll get onto the thresholds later on. So I'm not really getting onto the threshold as to what is the amount limit, 2 crore, 4 crore, 5 crore. So all of these threshold I'll pick up later on. Next is about this GST audit. Now, can the tax auditor be appointed as the GST auditor? Yes, of course. Now, as on this, what you should understand is that statutory auditor can be the GST auditor. There is no problem with this. Statutory auditor can be the tax auditor. There is no problem around this. Statutory auditor cannot be the internal auditor. Okay, that's against the ethics. And similarly, internal auditor cannot be the GST auditor. Clear on this? Yeah. Okay, so now though the time is not much, but quickly I'll just start with some of the particulars related to GST audit. Okay. So now starting with this GSTR 9C. So what I've done is I've just opened a form GSTR 9C. As I told you that all of these forms are filled online, and this is only for the purposes of our reference that this has been extracted in the form of this Excel, or you can say this is sort of utility which is then formed on this, which is then filed online. Okay. So part A. Part A, you remember that flowchart we discussed about the particulars which will flow into GST 9C. So this is part A. Part A will contain the information about the entity, the basic details about the entity. Means GST number, financial year, in this case you talk about financial year. It's not the previous year now. Huh? Legal name, trade name, because the trade name may be different. So that's why what's the legal name? Name of the act. If the entity is liable to audit under any act. Is the person making reconciliation statement from GSTR 9C is the same person who had conducted the audit of mentioned GSTIN? No, I think this answers your question, Jay. That they are specifically asking this, that the person who is preparing the reconciliation statement, is he also doing the audit? If it's the case, then can there be independence? Secondly, as around the trade name, let's suppose there's a proprietor. So proprietor is registered in the name of the proprietor, but for business purposes, his trade name is different. So that trade name will have to be specified. And all of these particulars, where can all of these be verified by the GST auditor from? Of course, from the records of the entity or of that individual or the company. And all of these particulars can be verified from the GST registration certificate also. Okay. Now, as around this company, let's suppose it's a private limited company or a company. So will this be liable to audit under any act? Yes, of course. And what act will that be? It will be the Companies Act 2013. Yeah. So this is the basic detail which will flow in over here and which is again required to be verified by the GST auditor. And there is nothing but the part of the GST 9C. So it basically goes from the GST auditor itself. Yeah. So now I will not be able to move on to part B considering the time. So I'll just look at your queries. And with that, we will conclude our discussion for today. And in the next session, we will continue with this the remaining part of GST audit, where we will also start a new chapter. So let me just get to your queries now. Harshad is asking, sir, like for income tax form 3CD is there. For indirect tax, GST form 9 is there. Yes, of course, it's similar to that. Form 9 is the form of the management, which is annual return. This is also called as annual return. Okay. Chavi is saying, is the tax auditor, GST auditor same or different? See, these are two different audits. And that's why these two auditors are also different. But that doesn't mean that that one same person cannot do these two audits. They can be done. Okay, they can be done. They can be done. It's not a problem at all. So a tax auditor can also become the GST auditor for an entity. Okay. Yeah. Thanks, Chavi, for this. So with this, I think we come to an end to our discussion on GST audit. In the next session, we will continue with the remaining part of the GST audit. Okay. And if you have any queries, questions, you can just send that across and we can have a discussion around that as well in the next session. All right. So thanks to all of you once again for your time and for your wonderful participation. Thanks so much.